Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. I am joined as usual by Mr. Corey Shepard. Corey was traveling last week, didn't get a chance to join me with our folks who were written about in the Wall Street Journal, that we talked a little bit about the strategies that they were in and what was missing perhaps from what they had done. And Corey, you know what? Today, just in honor of you not being able to make that, no unique introduction today.
Wow. Well, I do want to acknowledge you for using your relationship enriching words. You know, joined as usual. It's a great word because the always, nevers, you know, they just are never true. They never add to they create discord in a relationship. So thanks for bringing us back together after my week away. Really appreciate it.
Okay, guys. If anybody understood what Corey said, please put it in the comments. Translate it for me, because that didn't.
I'll talk to Chris.
Yeah, thank you. Yeah. Thank you. Yeah. All right. Well, guys, we've got a fun episode today. We are going to talk about this white paper that's periodically released from Vanguard. The last one was in 2019, talking about the benefits of working with an advisor. Now, not trigger warning, but some kind of warning is like, we are going to look at this paper. There's some good stuff in it. And we are not saying the reason this paper exists is the reason you should work with an advisor. There are some other criteria you should consider before engaging an advisor beyond this white paper saying, and if you go to our website, download it, link in the description below, you can read it for yourself. And it's a huge advocate for using an advisor, but we're going to give you some additional criteria or things that an advisor ought to be looking at with you to actually help you get the most, what they call alpha. And if you guys aren't familiar with that term, alpha just means additional returns above and beyond what would otherwise be expected.
And you know, as a financial advisor, I'm predisposed to liking that this article exists. Right? I like that, but I also just it's great for Vanguard, they started as the let the anybody person, the every person get some investing done on their own, and they have a retail platform to let people do it themselves. So for them to say using an advisor on top of that is helpful is a really cool thing to hear. But we also have to keep in mind that they have the Vanguard for Advisors platform where an advisor can sign up to use Vanguard funds with their clients. So this may be a support strategy for that. We have to keep that in mind. So,
well, and one thing you said there I think could be important for our audience is, yes, honor Vanguard for John Bogle's work in probably the single biggest company in democratizing the ability for individuals to at least have the possibility of effectively investing in the market on their own. But why did this Vanguard for Advisors pop up? How did it get created? Why did Vanguard, after years of saying advisors are overrated and awful and whatever, why all of a sudden did they build an advisor platform? And by the way, they're not the only no-load mutual fund that has done that in the last 15 years. Sure. And what it comes down to is some of the things in this paper is, despite all of the things that can negatively impact somebody as it relates to their finances, working with an advisor. You can have somebody that's disreputable. You can have somebody who market times. You can have those things. But overwhelmingly, they saw that their business model would be helped by having more advisors on the platform. One, just a little bit of a story from the COVID period here back in March of 2020, speaking with one of the larger platforms that allows both advisors on it and individual investors, and they call that the institutional side versus individual investors. And they said that literally the institutional side had a vastly different set of outcomes when it came to investor behavior through the COVID pandemic, and very different and more positive outcomes for the investors that were attached to an advisor. And we're going to hit that in part of this report. So we're going to jump in and we're just going to start a couple of pages in. If you guys are following along and you've done the download, you're going to see this, but I want to read one quote from kind of the introduction. And this talks a little bit about hiring somebody to do anything. This is on page 2. It's like the second to last paragraph in the right-hand column if you guys are listening to this on the podcast and just looking at the white paper. The same reasoning applies to other household services that we pay for, such as painting, house cleaning, or landscaping. Now, these can be considered negative carry services in that we expect to recoup the fees we paid largely as emotional rather than financial benefits. You may well be able to wield a paintbrush, but you might want to spend your limited free time doing something else, or you may suspect that a professional painter will do a better job. Value is in the eyes of the beholder. So along with all the other things that we're going to talk about that could add value in working with an advisor, I don't want to overlook the fact that for many of you out there, you're working 50, 60 hours a week, maybe you're climbing the corporate ladder, you're running a business, and you continue to be every single month employee of the month because you're the hardest worker inside the organization. And some of the value might just be in getting some of this off of your cognitive radar. For instance, we had a client send us a note this week, with everything going on with Russia and Ukraine. It is super tough to navigate from an investing perspective if you're out there on your own. And I just got a message from him saying, how much of our portfolio is in Russia? And I was able to answer that. It was less than 1%. It's super small because by the way, for all of you.
What did you say about the overall market cap of Russia that was really surprising?
Yeah, so GDP versus market cap, just to get everybody spooled up on it, market capitalization is the cumulative value of all their publicly traded securities. And because Russia is largely state-owned, that restricts, much like China, that you don't have that many companies you can publicly invest in. So Russia's market capitalization is less than that of Brazil's overall. So if you have an academically allocated, globally diversified portfolio, you have very, very little in a place like Russia. And despite all of the news and everything going on now, there is real tragedy, real death, real people being affected. I am not overlooking that. But the thing that I think about when I see and I scroll through the news feed and it's all Russia, Ukraine right now is the fact that, Corey and I were in the business back in, 2014-ish, when like the Greek people were rioting in the streets and their banking system was going to collapse. And every night on the financial news, they were like, this could destroy your portfolio. Well, they were less than 1% of an academically allocated, globally diversified portfolio for the entire country of Greece. And yet they made it sound like on the news, like it was all going to burn down. Now we're going to have some market volatility as a result of this, some up, some down, but rest assured, it's not that big of a piece of your portfolio that's even, it's only 10% Europe overall. So then a very small subset of that is Russia. Okay. So let's get down to, go ahead.
Well, yeah, back to the
Vanguard, this white paper.
Right, this white paper. I like this negative carry, this idea that you're spending money, but what it's not adding in there is it could be free time. If you're trading your free time for a paintbrush, like you're spending more on if you can do it just as well, then maybe you're not really saving money. But if it's affecting other productive time, then there's other value that you can get more than just what you're spending and what you're getting back. It's like what you're also adding in some third place. So that if you're not the employee of the month, but you're your employees keep buying you world's best boss mug every month after month, like there's some other value that might be gained as well, other than free time.
Yeah. Well said. So where we're going next is the bottom of page 4. And what this does is it lays out the case. Now, the white paper itself backs up each of these claims, but for the sake of our conversation, aside from a few things that we've highlighted, we're going to dig into just looking at each one of these. Now, here's the funny thing. The first one, and this used to be, I remember, I've been in this business 25 years, and I remember this used to be one of the highest value things an advisor could do, and that is suitable asset allocation using broadly diversified funds and ETFs. That is now barely more than zero. Like it is maybe valuable, but that used to be the primary value of an advisor working with a client. And now that one is kind of washed out to sea because people can access broadly diversified portfolios through tools like Wealthfront, Betterment, Vanguard, etc.
Well, it used to be that calling up your stockbroker and getting the good investing idea was the value of an advisor because they had their ear to information that no one else had. Now that's not a differentiator anymore. It's so it is funny. Like that's just an ante. That's pot stakes.
Yep.
To get into the game.
Yeah, well said. Then there's cost-effective implementation. So that just means being conscious of the expense ratios on the funds that advisors are using. Now, by the way, if you're reading this paper, you're looking at what's on our screen here on YouTube, the thing to notice is this entire paper is written to advisors, not to clients. That's a key distinction. So for you looking at this, Vanguard is advocating cost-effective implementation, controlling expense ratios, and they say that on average across what they've studied adds 34 basis points or a third of a percent, 0.34%.
Although, it's funny, Paul, they did write this in a voice directed at advisors, but they also approved it for public use, meaning
well said.
In the industry, some companies, they can more quickly produce content for advisors if they label it not for public distribution, meaning it hasn't been a super fine-tooth comb applied and approved for greater public, but they went to the trouble to do that, which means they do want the general consumer to see this.
Indeed. So the next one is rebalancing. Now, rebalancing should be, kind of make sense to folks, but it's this idea that if you have a set of assets, and we'll just use as example, a 60% stock, 40% bond portfolio, just because they're nice round numbers I can use. And let's say you hold that, what's going to outperform over time?
Stocks.
Equities. Yeah, every time. Oh, every time over time.
Over time.
Ooh,
that's
I like that.
That's like works 80% of the time, every time.
That's right. That's right. So every time over time, in all of our historical analysis, stocks as a whole outperform bonds. So let's say you don't rebalance. Well, then if stocks outperform bonds by 10%, then the next year you have 66% in stocks and 34% in bonds. And you can kind of picture that moving across and through time in especially our low interest rate environment. And in a good equity market, if say a good solid 3-4 year run of equities, you could be in the position where you now have an 80-20 portfolio, 80% stocks, 20% bonds. Now, Corey, I don't mean to put you on the spot, but
no, you almost always do. It's okay. Yeah.
Would you what would you say typically happens after equities have a really good run for a period of time? They've been going up every year for a few to 4 years. What eventually occurs?
Some kind of correction, some kind of dip in the market.
And this is something I would say to all of you is this is so tempting to not rebalance your portfolio, whether you work with an advisor or not. It is so tempting to be like, well, those stocks are doing so good. I don't want to exit out of them and rebalance to bonds because bonds aren't doing that good. Yes, but bonds are allowing you to take some of the chips off the table, that fixed income bond component. So if you're out there listening right now, and maybe you've selected an allocation inside your 401k, you haven't revisited it in a while, go back and look at your allocation. And if you're doing it on your 401k, maybe you've been working at that company 4 or 5 years, to kind of as a cheat sheet, you probably have the allocation you intended was the way you were initially invested. Maybe you haven't changed that. So if you were, say, 60-40, 60% stocks, 40% bonds in your initial funds that you picked, your portfolio might be 80-20 now, meaning the portfolio is now taking far more risk than you originally intended. And the reason it's taken on more risk is because you've been in a bull market. So when we enter into bear market territory, you're going to get hurt worse because of the equities outperformance, because now you're overweighted to stocks. So that's what they're talking about there, is the importance of that rebalancing.
And I like the note that they have in here a lot. Like, note that the goal of a rebalancing strategy is to minimize risk rather than maximize return. So they say it a couple different ways, but the investor should really hit the level of risk that they want and rebalance from there. Or if they don't have particular concern for the inherent risk, they just have 100% equity and there's no rebalancing to do except for among asset classes, which they don't go that deeper route. But here's what's just occurring to me, Paul, is rebalancing is an algorithm. Vanguard was already doing it in their individual funds. Mm-hmm. Like a Vanguard target retirement fund is going to rebalance over time. So now that I've read this a couple of times, I'm kind of like, is this really even an advisor thing? I mean, educating clients about the value of some of these things, but I'd put this like education as one of the ones that is missing in here potentially, not so much rebalancing as an advisor alpha tool.
I totally agree with that. And this is the other part that is the point that's made in this section, is that let's say your portfolio drifted 80-20 and you're okay with it. Then change your allocation to that. And here's why. Because when the market has its bear market, we need to rebalance in the bottom of that bear market. We reached out to every one of our clients we could get a hold of during the COVID market drop because we looked at it and I was, now, by the way, this is not market prognostication, okay? But I am on podcast, I am on video saying that this market, the one that where the COVID went down and people were losing their ever-loving minds, I said, this is not the same thing we had in the financial crisis. Financial crisis was the machine was breaking and we had to fix it while the market was going on. COVID, right, in terms of market terms, was a little bit like we had a well-oiled market machine, that the economy that was going well, but somebody threw a dirty towel in the front end called COVID. And that gummed up the works for a little bit, and it was temporary. And I was one of the only people out there publicly that said, I think the S&P is going to recover by year end. Now that, again, that wasn't me saying this is how it's going to go. But by the way, the other thing that I said in that same talk was it's going to recover by year end. And if it doesn't, it will recover. It wasn't life is burning down, all of that.
I think the big point of the big difference in all of that, Paul, is that we weren't telling anybody to do anything that they weren't already going to do. It was just strategies that were already in place. We say, well, fast forward that cash into the market a little bit because why not, right? It wasn't totally changing your whole financial strategy because of this temporary thing.
Exactly right. And rebalancing, when we've had a market pullback, we can't catch the bottom because we never know when the bottom is. Right. But by rebalancing, so if you have that 60-40 portfolio that became 80-20 over time, and then the COVID pullback of March 2020 hits, and you don't change your portfolio, you just got a 60-40 portfolio again. You never took advantage, because if you had said, okay, I'm 80-20, then it went back to 60-40, you'd be taking 20% of your fixed income and buying on that huge dip that had the stock market priced the same as it was back in 2017. Like you got 2017 prices in 2020 if you rebalanced at the bottom. Okay, so that's the benefit of rebalancing. And by the way, that rebalancing, which is going to tie a little bit to this behavioral coaching, but if you're working with an advisor that does that rebalancing for you, unemotionally, systematically, and you might go, oh, I'm paying them 1% and it's terrible. It's like, well, they just on one rebalancing at a time that it took courage to do so and took guidance and leadership and somebody else that wasn't the mishmash of the market yelling at you. Well, that one time may have paid that advisor's fees for a long time.
Yeah. Which is really the next one, behavioral coaching.
Mm-hmm. And they value that one at 1.5%. Like I want you to get further into it, but I just wanted to make that clear to people. Right. They value that at 150 basis points. So keep going, Corey.
Or they even say right here in the actual section, because I got another one open with some of my notes. It's 1 to 2% net return is what they say in the actual section. So it could be more than 1.5%. And here's the big takeaway from the data that they pull is they do a study on Vanguard target date funds versus other allocations where folks are taking money out.
Yep.
They do
if
an
they
exchange.
moved money once during a bear market.
Right. And accounts that had an exchange, money went out, were underperforming on average 150 basis points. So right there, and we've looked at Dalbar studies in the past that compare the average of the market to the average actual investor, looking at their statements and how they tend to underperform. And it's that investor behavior. It's one of the main ways that we can create a vacuum, sucking away the rate of return that the market was going to give anyway. And so I love this grounding here for that happening. And that's like what you talked about at the beginning, Paul, with advised accounts versus non-advised. What we saw, it was huge net outflows during the pandemic versus huge net inflows with advisor related money. And that money continued to grow over that period. So big difference.
I want to translate that in case the little bit of industry speak there didn't land with you guys. That is that with many firms that don't have primarily an advisor attached to their clients, or firms where advisors don't do a good job of selling people investments, but not a good job of coaching and educating them, see tremendous outflows, meaning money going out of the investments into cash during those periods of time. Versus the people that are coached, et cetera. Like we actually had a back office at the time that was handling our trading, and we were having to call at 9 a.m. because everybody that used this same back office was also coaching their advisors. And so we called and said, hey, we need to get these clients invested and rebalanced, and this client has a little extra cash they want to put in. And they would say, okay, we're going to do our best. And I'm like, oh, what's going on? Thinking maybe a lot of people were selling, and here we were the lone wolf saying put money in. They said, no, all of our clients are adding money. But one thing that I think is key around this behavioral coaching actually goes to this, it's a little part that I highlighted, Corey, under conclusion on page 6. It's in the first paragraph, last sentence. Says, some of the best opportunities to add value occur during periods of market duress or euphoria, when clients are tempted to abandon their well thought out investment plans. Now, I read that slow because I think it's key. It's that having somebody there, like how many times have we seen people here crypto was on that huge run. And how many times did we get questions from clients saying, hey, maybe should we be investing in crypto, all that? Well, like as we stand today versus where the prices were when it was this very recent high, you would have lost 50% in that investment.
Yeah.
Currency, whatever you want to call it. But
right.
But that literally saving people from that. So let's say somebody said, I want to put $100,000 there. Well, you save them a $50,000 loss and more than that in lost opportunity costs because the market kept marching forward while that one single investment took a hit. So what's key is that another one would be is somebody say, well, now's the time to change your asset allocation. Maybe you shouldn't have as much in international. Well, if you do that, and international has been lagging over the US markets, but the markets that lag are the ones that are likely to perform better in future years. So we're going to get out of those markets at the time when they've not been performing well. No, that's the very time to continue to hold them because eventually they come back. All the reason why holding your allocation and an advisor that's encouraging you to do so, or if you are a total do-it-yourselfer, what you might need to consider is putting in some kind of accountability to make sure you don't do that. I knew a guy who he was investing in individual stocks, which, we don't encourage, but I did like the accountability he put in. He had his teenage son change his password to his trading account. So on any day, and he said, I think something to the effect of, I'm going to give you $500 if you don't give me my password before the S&P 500 comes back to its pre-pandemic levels.
Nice.
And that created an accountability that made sure he didn't take inappropriate or rash action on the things that he bought at the bottom. Okay, let's hit the next one.
Asset location. Now, well, so the thing that we talked about this one a little bit at the beginning already, and they talk about, where to put different assets and different kinds of accounts for taxability benefits. The other thing that I wish that they would talk about is time availability, like thinking about how to positioning enough cash to let the rest of your portfolio do its thing. Morgan Housel, Psychology of Money, one of our favorite books in recent years about personal finance, was just talking about, even though this savings account gets effectively zero, there's a real rate of return to having money in cash because it allows you to let your other investments play out and not pull out at inopportune times. So that's another part of asset location. But of course, this is an article marketed to advisors, and huge cash positions tend not to get paid asset fees. So that might be why this is left out of here, or at least not that they intentionally left anything out, but there's this real inertia towards what generates revenue that can be tough to break. I'll put it that way.
I would agree. And I think that one other thing that's, when we look at something like this, we're like, what's missing, flawed, incomplete, or weak about what they're saying? And something that's missing, or maybe this one's incomplete, is this idea that, well, if you held, and this is the basic concept of asset location, if you had 50% bonds, 50% stocks, and you have 50% of your money in an IRA and 50% of your money outside the IRA, then on an Excel spreadsheet, not in real life, if you analyzed the growth of the bonds and the fact that they're income taxable in a individual account versus stocks, you'd say own the stocks personally, put all the bonds in the retirement plan. That is really going to help you a lot.
Right.
Except that's going to put us in the position that 100% of the money we have access to on a daily basis to buy the vacation home, help pay for a wedding, or just feel more safe in times of market volatility. Well, 100% equities is what we have as our, we teach is the midterm bucket.
Yeah.
Well, you will break strategy, freak out, and abandon that in hard times.
Yep.
Okay. So that's why the asset location, that I think they're right that it's 0 to 75, because maybe there's a slight benefit unless you put somebody in a position that's a strategy they cannot hold. And then I like this next one, spending strategy, withdrawal order. Now, by the way, the withdrawal order comes back to the fact that Vanguard is looking just at you've already accumulated assets. And then which order should you withdraw them in? What there's no conversation about is what order did you build them in? Because if you had a 401k and that's all you did was throw money in there, they mentioned right here in this paper totally expose and admit to it without talking about how easy it is to fix the problem. So if you're retired with all 401k money, then there's really no value. That's why it's 0 to 110 bips, because we don't know how you have your money invested. But nothing about maybe that client should have taken a little more effort to convert some IRA to Roth, or perhaps put money in the Roth 401k. Or maybe what they should have done is built some non-qualified investments. Maybe they should own whole life insurance. Maybe they have real estate in their portfolio, and that's a factor in their spend down.
Right.
None of that, because the only thing they're dealing with is your investments. So there's no conversation about proper exiting of your business. There's no conversation about positioning cash maybe over time, as we've talked about in the podcast, into whole life insurance cash values instead of leaving 200,000 of your emergency funds sitting in cash at a bank for 30 years. That's all left off, and that's the biggest piece that's missing from this entire picture. Is how did you position yourself before you got to retirement so that the cash flows in retirement gave you the greatest possible opportunity? I'll give you one quick example. Meeting with this amazing couple yesterday, and they've done a good job. They're really, really good at setting aside money into investments. And one of the things that they've been told over and over again is that you should just put money in pre-tax contributions. And they've got millions of dollars. They're in their 40s. Like they've done a great job with regular kind of income, but just not spending all of it, saving like 50%. Really incredible. And we had to talk about the fact that right now, something like 90% of their investments are either non-qualified or in pre-tax retirement, and only very, very little is involved in any tax-free like Roth. And it's a very simple strategy for them to start channeling some of this money toward Roth. It's just nobody had taken the time to teach that to them before, because everybody's focused on what is the biggest quote unquote number you can have without a conversation about how you're going to withdraw it. And then I take issue of one last little thing on total return versus income investing at the end here. Now,
I mean, kudos for going there in the first place, because I think there is a big narrative, like it's a default narrative in the financial industry. Like, you're getting older, you want some income, let's set up an income generating portfolio with bonds and stocks that shoot dividends out to you.
Because they get to sell you something new. That's why it's prevailing. Because you've had this kind of portfolio, and I'll sell you on getting this other kind.
And the corpus stays in the portfolio. Like it's a different. You don't have to sell out anything that was already there if we're consuming. And that's what they talk about here is total return versus income investing. So you can create an income generating portfolio, or you can spend from the total return of the portfolio. And we talked to a lot of clients about how that gets them more predictably to the same place or better than a income quote unquote producing portfolio. But they don't really weigh in on an overall answer in here. They just kind of say, here's some different places you could go. So I don't know what the data is that they're suggesting.
Well, if you look at those, and usually people say, well, I want some dividend payers. And the trouble with getting those dividend payers is the reason. Why is a major public company kicking out, I'm not saying any dividends, because many of them do, but I'm talking the inordinate dividends that are giving you like 5% cash flow on your money. Number one, your principal's still at risk. It's not a bond. It feels like one a little bit. But second, the reason they're paying out an inordinately sized dividend is simply because they haven't found an effective use of capital inside the enterprise. And if that company is being compared over the next 10 years to a company that is finding appropriate use of capital inside of the enterprise to grow the enterprise value, well, it's kind of obvious which one of those two is going to outperform over time. And you can see that if you see these high dividend payer stocks and watch what kind of happens to your principal if you had invested in those over time, is your principal can actually take a hit over time. And even if it doesn't take a hit, it probably won't keep up with the overall performance. But in this paper overall, what they're discussing and everything they get to is it's about a 3% increase in net returns for somebody working with an advisor using some of these strategies. And what I think Corey and I would say is if your advisor is also looking at your balance sheet holistically, they're looking at how do you invest with outside of them? How are you deploying your 401k that they don't manage? Where's the most effective way to make your next contribution? Should you or should you not dabble in rental real estate? And if you did, how would you go about doing it so that you don't get burned? Those kinds of things that we do for our clients, and there are some other advisors out there that do this for their clients. That return might be mid double digits in some years simply because they were able to look at the whole and make it work more efficiently, not just say, here's how this investment did. All right, Corey, I think we took a lot longer with that than we intended. I hope it was valuable for anybody. Anything we need to hit before we leave them off today?
Not at all. This is great.
All right, guys, we hope that you enjoyed this episode. We always enjoy it. Please be sure to like, subscribe, comment below, and we hope that this has been a contribution to you being able to design and build a good life.